You ever open up a price chart, um, stare at those flashing green and red candles, and just get this creeping suspicion that the market is actively watching you?
Oh, absolutely. Every single day when you're starting out.
Right. Like, you finally decide to buy after watching a stock climb for hours, and the very second you click execute, it just violently drops.
Yeah, it leaves you feeling like the whole game is basically a rigged carnival attraction.
Exactly. Like the guy running the booth has his foot on a secret pedal or something. I mean, you were looking at thousands of indicators, you're drawing all these trend lines, and yet it constantly feels like someone else has a copy of tomorrow's newspaper.
Well, that is the universal beginner experience. You step into this arena thinking it is a free and open auction, but the reality is you're stepping into a highly structured environment.
Highly structured.
Yeah. It is less like a public marketplace and much more like walking into a casino where the house processes like millions of data points a second.
Mm.
And the house absolutely has an edge.
Which is terrifying for a new trader. But welcome, listener, to this deep dive. Today, our mission is to act as your personal trading mentor and, well, finally give you that edge.
That's right.
We are taking a notoriously dense, kind of intimidating stack of Inner Circle Trader or ICT source materials, and we are going to transform it into a clear, step-by-step mentorship session just for you.
Because it can be a lot to digest.
Oh, it's a ton. But whether you are a brand new trader trying to figure out where to even start, or someone who has been staring at charts for years and just feeling overwhelmed, we are cutting through the noise today. We're breaking down the concepts of market algorithms, institutional order flow, and trading psychology.
And the ultimate goal here is really practical, actionable application. By the end of this deep dive, you will have a clear, logical roadmap to approach your charts.
A roadmap.
Exactly. You're going to know exactly when to look, where to look, and how to execute your trades without feeling that paralyzing anxiety that washes over so many retail traders.
Okay, let's unpack this. Because before we even look at a single candlestick on a chart, we kind of have to completely rewire how we think the market actually operates.
Yeah, it's a total paradigm shift.
It really is. Because the core premise from these sources is radical if you grew up on, traditional trading advice. The markets are not random.
Right.
They are not just organically reacting to news events or the collective feelings of millions of retail traders buying and selling. They are driven by something called the Interbank Price Delivery Algorithm, or IPDA.
And that right there, that is the foundational shift in mindset. Once you accept that price is delivered by an algorithm, everything changes.
How so?
Well, you start to realize that price delivery is systematic. It is methodical. It is not some unpredictable beast roaming the wilderness. It is a computer program functioning on a very specific set of rules.
And computers don't have feelings.
Exactly. They do not care about a company's earnings report or like a CEO's tweet. They operate on historical data ranges and look-back periods.
Which brings us to the first major rule the sources outline, which is the 20, 40, and 60-day rule. The material explains that this algorithm specifically looks back at 20-day, 40-day, and 60-day ranges to find its targets. But I have to push back immediately here.
Okay, go for it.
Why those specific numbers? If this is a super advanced algorithm running the financial world, why is it arbitrarily looking at 20, 40, and 60 days? Why not 15 or 100?
That's a great question. And the thing is, it's not arbitrary at all. It comes down to a concept called open float and the actual calendar of high finance.
Okay, the calendar.
Yeah, think about how large institutions, sovereign wealth funds, central banks, how they operate. They are not day trading on 5-minute charts.
Right, they aren't scalping.
Exactly. They operate on macro shifts, usually tied to financial quarters. And a trading quarter is roughly 3 to 4 months, which translates to about 60 trading days.
Ah, so the 60 days is literally a business quarter.
Yes. And the 20 days is roughly 1 trading month. The 40 days is 2 months.
Okay, that makes so much more sense.
Right. So the algorithm is hunting for the open float, which is essentially the resting liquidity that is built up over these specific time frames. Every single quarter, the market undergoes a major shift to reset this liquidity pool.
Resetting the pool.
Yeah, the algorithm looks back 20, 40, and 60 days because it needs to find the highs and lows established over those exact periods. That is where the most significant orders are resting, just waiting to be triggered.
Hold on. Liquidity is a massive buzzword. People throw it around on financial television all the time. Before we go any further, for the listener staring at a chart right now, what does liquidity actually look like in plain English?
In plain English, on a price chart, Liquidity is simply the cluster of stop-loss orders placed by other traders.
Stop-loss orders.
Yes. Think of it as fuel. If a giant bank wants to buy a massive amount of currency, they cannot just click buy on their app like a retail trader.
Because it's too much money.
Way too much. Their order is so big, it would instantly send the price skyrocketing, giving them a terrible entry price. So for every massive buyer, there has to be an equal amount of sellers.
So they need people to sell to them.
Right. And where is the biggest group of guaranteed sellers?
Let me guess. The people whose stop losses are about to get hit.
You got it. It is the people who bought earlier and placed their sell stop-loss orders right below a recent low. So the smart money basically drives the price down to that exact level.
Wow.
They trigger your stop-loss, buy your position at a massive discount, and use your order as the fuel to fill their own massive position.
So the algorithm is essentially like a commercial fishing boat using sonar. I mean, it doesn't just cast a net randomly into the middle of the ocean.
No, not at all.
It looks back over the last 20, 40, or 60 days to see exactly where the massive schools of fish, or, in this case, retail stop-loss orders, have gathered, and then it just drives the boat right over them.
That is a perfect way to visualize it. Over a 60-day period, retail traders build up these very obvious support and resistance levels. The algorithm sees that massive buildup of liquidity, drives the price there to scoop it all up, and triggers that quarterly market shift. If we connect this to the bigger picture, you realize that every 3 months, the market is engineered to do this.
Okay, so I understand the algorithm operates on this 20, 40, and 60-day clock to hunt for volume. That covers the when. But if I'm staring at a chart right now, how do I know where it's going next? Like, how do I know if it's going to hunt the highs or hunt the lows?
To figure out the destination, you have to start viewing the market exclusively in terms of premium and discount.
Premium and discount.
Yeah. Imagine a daily trading range like a seesaw. When the market is too expensive or at a resistance level, it is in a premium. When it is too cheap or at support, it is in a discount.
And the middle.
The exact middle point of that range is called equilibrium. The fundamental nature of the market is to move from a discount up to a premium, or from a premium down to a discount. It is constantly seeking to balance the books.
And the sources say that to find these precise premium and discount zones, we use these things called PD arrays.
Right. Premium discount arrays.
But looking at the source material, there's a massive list here. I'm seeing mitigation blocks, breakers, liquidity voids, fair value gaps, order blocks, rejection blocks. I mean, that is an absolute alphabet soup of jargon. If I am a new trader trying to build a foundation, I am instantly overwhelmed.
Which is completely understandable. The materials present a whole hierarchy of tools, and you do not need to memorize all of them on day one to be profitable.
Oh, thank goodness.
Yeah, to keep the cognitive load light, we're going to focus on the 2 most foundational arrays that you can start spotting on your charts today: order blocks and fair value gaps.
Perfect. Let's translate those. Start with the order block. Break that down for us.
Okay, imagine you're looking at a chart and you see a massive explosive move upward, like a huge rally.
Okay, I see it.
Before that massive up move, there was a final down candle. That last down candle before the explosive rally, that is a bullish order block.
Wait, why that specific candle? Why does the last down candle matter?
Because that specific candle is where the smart money, the institutions, did their heavy buying. They absorbed all the selling pressure there, accumulated their massive positions at a discount, and then let the price run.
Okay.
Because they bought heavily at that exact price point, that area becomes highly sensitive. It is basically their footprint. When price eventually returns to that specific down candle, the algorithm will typically defend it, and you will see massive support.
So an order block is essentially the literal footprint left behind by the smart money. You see where they stepped right before the market took off, and you patiently wait for the price to come back to that exact footprint so you can catch the next ride.
Got it. Now, what about the fair value gap, the FEG? A fair value gap, or FEG, occurs when price moves so incredibly fast in one direction that it leaves an empty space, or a gap, on the chart.
An empty space?
Yeah, think of it like painting a wall with a roller. If you swipe the roller down way too fast, you miss a spot, leaving a streak of unpainted wall.
Oh, that's a good analogy.
In the market, that fast move means price was only delivered on one side. Buyers overwhelmed sellers so quickly that the transaction wasn't efficient.
But why does that matter? Like, why does the algorithm care if the market moved fast?
Because an algorithm's core programming is to balance the ledger. Its job is to efficiently match buyers with sellers at every single price level.
Right.
If a price level is skipped entirely because the market moved too fast, The ledger is incomplete. The algorithm absolutely hates inefficiency.
So it has to fix it.
Exactly. That empty gap acts like a massive magnetic pull. The algorithm will almost always draw the price back to fill that gap,
Hmm.
essentially repainting that missed spot on the wall to balance the books before it continues its original trend.
That makes so much sense. It literally has to balance the books. So we now have our contextual map. We know the 60-day cycle. We know price oscillates between discount and premium. And we are looking for magnets like fair value gaps or footprints like order blocks.
You're tracking perfectly.
But here is the critical part. Let's say the price finally reaches our premium zone. We see the order block. How does the market actually turn around? Because I know so many retail traders who get chopped to pieces trying to catch a falling knife, assuming a reversal is happening when it just isn't.
It is a really dangerous game if you don't know what to look for.
Yeah.
Institutionally speaking, the sources note that the market really only turns on two specific patterns: a failure swing or a breaker.
Okay, failure, swing, and breaker.
The failure swing is fairly intuitive. Price tries to reach an old high or an old low, and it simply fails. It runs out of gas before it gets there, proving the underlying momentum is exhausted, and then it reverses.
Simple enough.
But the breaker is the most powerful and, frankly, the most devious trap in the entire market.
Okay, a devious trap. I love it. Walk us through exactly how the breaker works.
Let's say we are looking at a very obvious resistance level. Price rallies up, falls just short of the resistance, and drops a bit. Retail traders see this and think, resistance is holding, time to sell.
Right, time to short.
So they enter short positions, and they put their buy stops, their stop losses, just above that old high. Then the algorithm drives the price up one more time. It pushes just above that old high.
Wait. If the price breaks an old high, every single trading textbook tells you that is a classic breakout. You are supposed to buy that. Are you saying standard retail trading advice is actually what gets you trapped?
That is exactly what I'm saying. Standard retail advice is often the liquidity provider for smart money.
Wow.
When price pushes just above that old high, breakout traders start buying aggressively, thinking a massive rally is starting. At the exact same time, those early short sellers get stopped out, which forces them to buy to cover their positions.
Oh, man.
The algorithm has successfully engineered a massive concentrated pool of buy orders.
It's a total feeding frenzy.
Exactly. And once all those retail buy orders are triggered, the smart money unloads their massive sell orders directly into that liquidity. The market violently reverses downward. That is a bearish breaker. It literally breaks the individuals who thought they were playing a textbook breakout.
Here's where it gets really interesting, actually. It's just like a classic fake out in sports. Think about a point guard driving to the hoop in basketball.
Okay, yeah.
They look left, they dip their shoulder, and they draw the entire defense over to that side of the court. The defense fully commits, and the second they do, the point guard throws a no-look pass to the right for a wide-open dunk.
That is exactly what's happening.
The algorithm is the point guard. It lures retail traders in one direction, forces them to commit their capital, and once the defense is entirely out of position, it grabs their orders and runs the market the exact opposite way.
If we connect this to the bigger picture, you start to see why patience is so critical. Understanding the breaker pattern prevents you from being the defense that gets faked out. Instead of jumping at the first sign of movement, you wait for the fake out to happen.
Let them get faked out first.
Yes, you watch the tops get run, and then you enter your trade in the true direction of the smart money.
Okay, so we have our chart set up and we know how to spot the trap. But let's zoom out for a second. How do we confirm the macro trend before we actually risk our hard-earned capital? I don't want to just stare at one tiny currency pair in a vacuum. I want to know the broader context.
Of course.
And the sources dive heavily into intermarket analysis and seasonal clues to build that context.
And they should, because no market exists in a vacuum. Money is finite, and it constantly flows from one sector to another. This is the essence of intermarket analysis. For example, the sources detail the relationship between bonds, stocks, and commodities.
How are they linked?
Generally, bond prices and stock prices move together, but bonds and commodities typically move in opposite directions.
Really? Why is that? What is the actual mechanism connecting them?
Well, it basically comes down to interest rates and inflation.
Okay.
If bond prices are falling, that usually means interest rates are rising. Rising interest rates often signal inflation, and during inflationary periods, hard assets like commodities, gold, oil, wheat, they tend to surge.
Ah, I see.
So if you are analyzing a chart and see a massive long-term shift happening in the bond market, you can anticipate the delayed ripple effect it will have on commodities or currencies heavily tied to commodities. It gives you a macro bias. You aren't just guessing, you are following the flow of capital.
That makes a lot of sense. And then there are seasonal tendencies, which feel almost like a cheat code when you read about them in the sources. The material highlight that the Canadian dollar futures contract historically rallies between March and June.
Right, it's a very strong historical roadmap.
Year after year, over decades of data, there is a massive tendency for it to go up during that specific time window. But I have to ask, if I'm sitting at my computer trading the US decade Forex pair, does that mean I just look at the calendar, see it's March 1st, and blindly hit the buy button?
Absolutely not. That is a critical nuance that constantly traps amateur traders. First, a seasonal tendency is a historical roadmap, not a guarantee. You still need your PD arrays, your order blocks, and fair value gaps to actually confirm the setup.
Right, you still need the setup.
But more importantly, you have to understand the specific instrument you're trading. The seasonal tendency the source's reference is for Canadian dollar futures. But if you are trading the USD CAD Forex pair, the US dollar is the base currency.
Which means?
That means the Forex pair is mathematically inverted to the Canadian dollar futures contract.
Okay, let's slow down and make sure the listener really grasps this because inversion trips up a lot of people. If the Canadian dollar futures contract typically goes up from March to June,
Then the USD CAD Forex pair will typically go down during that exact same period.
because of the base currency.
Right, because as the Canadian dollar gets stronger, it takes fewer US dollars to buy it, pushing the chart downward. You have to invert the seasonal bias depending on how the currency pair is quoted.
So, if I know the USD CAD pair should be trending down in April, and I see the price rally up into a premium zone, hit a bearish order block, and form a breaker trap, I have the perfect storm.
Exactly. You have time, price, and macro fundamentals all agreeing with your trade. Your odds of success are exponentially higher.
All right, we have built the ultimate contextual map. We have the 60-day cycles, the premium and discount zones, the breaker traps, and the seasonal confirmations. But let's be real. None of this matters if you cannot execute.
Execution is everything.
Right. How do you actually pull the trigger? And more importantly, how do you survive the mental game of trading? Because knowing where the market is going is entirely different from having the mental fortitude to trade it.
That is so true. Execution requires precision, not emotion. The mentorship sources strictly recommend using limit and stop orders based on daily chart closes.
Instead of market orders.
Yes, instead of jumping into the market while a candle is wildly moving up and down, which triggers adrenaline and panic, you wait. You calmly identify your bullish order block. You place a buy limit order precisely at the opening price of that specific down candle, and you just walk away.
You set the trap.
You are setting your trap at a deep discount, waiting for the algorithm to pull price back to that footprint.
You let the market come to you. But then there's the waiting period. And there is a profound quote from the source material that stuck with me. Time is a murderer. It sounds dramatic, but what does that actually mean for a trader's mindset?
It means that waiting for these higher time frame setups to play out is psychologically agonizing. Imagine you enter a perfect long-term trade. Your analysis is flawless. But for the first 3 days, the market slowly drifts against you.
Just sitting in the red.
Yeah, you go into drawdown. You know the price should eventually reach your target, but you do not control when it gets there. Time kills traders because they lose patience.
They start second guessing.
Exactly. The agony of waiting makes them doubt their own analysis. They panic, exit a perfectly good long-term position for a loss, and then watch in horror the very next day as the market rockets exactly to where they predicted it would go. You have to submit to both price and time.
And to survive that psychological agony, the sources give a very strict rule for money management. You should only dedicate 30% of your account equity to these long-term position trades.
Yes.
Now, I can hear a listener right now saying, but my account is only $1,000. If I only trade with $300, I'll never make any real money. Why is this 30% rule non-negotiable?
It is non-negotiable because it is fundamentally about survival.
Yeah.
If you tie up 100% of your $1,000 account in a single trade that takes 3 months to play out, every little daily dip is going to feel like a heart attack.
You'll be sweating every candle.
You will micromanage it to death because your entire net worth is on the line. You will break your own rules. But if you only risk 30% of your equity on the long-term idea, you have 70% of your capital completely free and liquid.
So what does this all mean for you, the listener? Keeping that 70% free allows you to take short-term day trades or scalp the market while your long-term position quietly works in the background.
Exactly.
It completely neutralizes the emotional panic of watching a long-term position experience natural everyday drawdowns.
This raises an important question, though, that every single trader has to eventually ask themselves. How much financial pain can you actually handle before you break your own rules?
Probably not much for most of us.
Right. For a beginner or even an intermediate trader, the honest answer is usually not much. Limiting your exposure to 30% is the ultimate defense mechanism against your own impatience and fear.
All right, let's quickly recap this step-by-step mentorship process so you, the listener, have it locked in before your next trading session. First, identify the IPDA 50-day quarterly cycles. Know where the liquidity has built up over the last quarter.
Second, locate your premium and discount targets using PD arrays.
Right, look for those fair value gap magnets and order block footprints. Third, wait for the breaker trap to spring. Let the retail traders get faked out before you enter.
And finally, execute with strict limit orders and ironclad money management, risking only 30% on the long-term view.
It is a phenomenal framework. It strips away the anxiety of a random market and replaces it with cold, hard logic.
It really does.
But before we wrap up, I have one final provocative thought about all of this. If the Interbank Price Delivery Algorithm is fundamentally a computer program relying on rigid 20, 40, and 60-day historical data loops to trap retail traders, what happens to the ecosystem?
What do you mean?
Like if the majority of retail traders eventually decode these exact rules and stop providing the liquidity the algorithm was built to hunt, what happens?
Oh, wow. It's a fascinating thought experiment. If millions of retail traders suddenly stop placing their stop losses in obvious places, and they stop buying textbook breakouts, they stop providing the very fuel the algorithm needs.
Does the algorithm evolve or does the entire game break entirely?
If the house loses its edge, something has to give. It is definitely something to keep in the back of your mind as you navigate these markets.
A perfect thought to end on. Thank you for joining us on this deep dive. I highly encourage you to open up your trading platform today and just look at the last 60 days of price action with completely new eyes. Find the fair value gaps, spot the breakers. Remember, you aren't playing a random game of chance anymore. You are playing against the house, but now you know exactly how to read the algorithm's cards.